Thank you everyone for joining this Founders Group webinar. I am Ben Wiggins, one of the members of the Founders Group, and today we are going to be talking about startup traction. So the three most important elements that most investors are wondering about, are going to want to see evidence of, are traction, team, and market. We talk about the big 8 elements. The most important 3 of those are traction, team, and market. Now, as a founder, you may be saying, well, I would love to have revenue, but I don't have revenue. I'm pre-revenue. So that's an obstacle to overcome. And today we're going to talk a little bit about revenue, but also about other forms of traction and how you can demonstrate value to investors on the traction side pre-revenue. Now, once you start taking on revenue, your valuation increases. There's just no doubt about it. But sometimes you're in a situation where, well, I need to get investment before I can get revenue. I've got this big capital expenditure that I just can't get around. And so fair enough. So let's talk about all the different forms of traction, and then we'll open up for questions after the structured presentation is done. So I'm hoping to spend about 15 minutes on the presentation itself, maybe 20, and then we'll open up for broad Q&A, and you guys can ask any question you want, and I will do my best to get it answered. And if not, somebody else may be able to help. We've got several other investors and moderators around here, and they may be able to contribute to the process too. So key metrics that you can present to investors to let them know that your startup has the holy traction. All right. So, can't get revenue without investment. Can't get investment without revenue. Well, in many cases, both are wrong. What this slide is really about is sometimes I hear founders saying things like this, and really what it's about is they want an excuse for why they're not moving forward. They want to hear a yes from somebody else to give them permission to go be who they want to be in life. And as a founder myself, as a many-time founder, as a many-time failed founder myself, I have no patience for that at all. Now, there are certain situations where there is just an insurmountable obstacle standing in the way of revenue specifically. But oftentimes this is used to generate, well, an investor hasn't said yes to me, and I can't go, an investor's never going to say yes without revenue, and I can't get revenue without investment, so I'm just hosed, and woe is me. Sorry, I mean, life is hard. Life as a founder is especially hard, and we are here to help. I am here to help. Like I said, I've failed as a founder many times. We're here to provide the resource that I didn't have when I was younger. So we're here to help, but I don't want to hear excuses. Now, work through challenges together? Yes, let's do it. So obviously, revenue is the best form of traction. So let's talk about what are the best forms of revenue specifically. MRR is the best form. Active recurring revenue every month. So MRR is monthly recurring revenue for anyone who's not familiar with that. You'll also hear revenue per year, or ARR, annual recurring revenue. That is the best form of revenue because, at least to some degree, it's guaranteed to continue. The next best form of revenue is the non-recurring revenue. So these are just deals that you're doing on a one-off basis, here, there, and yonder. And some of those may actually continue, but they are not contractually guaranteed to continue. The customer has to continue to opt in instead of having to opt out. And that distinction really matters. It matters in elections. It matters in business. It matters in all kinds of things. But if you don't have the actual money in the account, if it's not actually hitting your books yet, the next best form of revenue is close deals with deposits, even small ones, because these signal commitment from customers. Deals that are signed but don't have a financial deposit are okay, but they're less real because, as I can tell you from painful experience, I have had a signed contract for it well into 5 figures, and some of you guys have probably experienced this in 6 or 7 figures, more than I have, but I've experienced a customer just flat backing out and saying, sue us, we're not doing it. We decided we don't want to do business with you anymore. And we thought about it. We thought about suing them, and we approached our attorney, and he was like, look, you're going to spend more than you're going to make. It's just not worth it. Let these jokers go. And we did. Painful lesson for me. So But a financial deposit, even a small one, does make a difference. When you take on your first dollar of revenue, even if it's just $100 deposit on a $10 million deal, that deal becomes much more real. So getting your customer to say, yes, I will put a tiny amount of money down. Once they have made any kind of financial commitment, your valuation at least doubles overnight. You guys have probably heard me say that before, but for anyone who's new to these webinars, your valuation doubles overnight when you take on your first $100 of revenue. Just give that some thought. So getting somebody to sign a deal, even if they don't have to pay for it now, even if you're pre-product, even if I don't have even step one toward the MVP, all I have is an idea, but somebody has paid for it, your valuation doubles overnight. So, and maybe more than that, it may 10x overnight. I'm not, not making any promises beyond double, but your valuation will absolutely go significantly up when you get your first money in the door. All right, next, what is best after revenue? And we're gonna group these into buckets, and there might be a little bit of shuffling among like what is highest priority, but the next bucket of most valuable after revenue is user engagement. So you have users of some kind, and they are engaged. So what are the most valuable forms of that? You've got your daily active users, weekly active users, monthly active users. These enable better insights. The more often that they're active and the more that they're engaging, the more valuable they are. The next most valuable are retained users. Even if they're not engaging, if they stay on your platform over a long period of time, then cohort stickiness is a good measure of user base, even if they're not paying yet. And then finally, a qualified waitlist or a qualified set of users. Even if they're not on your platform yet because the platform isn't built or whatever, for whatever reason, knowing that you have a waitlist, even if they've never paid you $1, that's better than nothing. All of this is going into the much better than nothing category. And what we're trying to take away is our own excuses. And that includes me too, by the way. Sometimes I'll hide behind excuses too and be like, well, I can't go build it because nobody has said yes to me as an investor. I've done that. I've been guilty of that. But we're trying to eliminate those excuses so we can punch the gas and move forward as founders because we are people of action. Next best category is doing business but not getting paid. So we don't have the users necessarily. What we're talking about now, we're moving into key assets and partnerships like LOIs. What's an LOI? It's a letter of intent. You'll also hear letter of interest, which is not the same thing. A letter of intent I would say it is a borderline legal commitment to do business with you. Now, again, people will back out of legal commitments. And so just be aware that does happen. An MOU is a memorandum of understanding, a memo of understanding. And that is basically saying that they find your service valuable and they would like to use it. These things have varying legal strength. An MOU is not really legally enforceable. An LOI may have some enforceability. So signed LOIs matter. If you don't have, and by the way, I have committed to investment based on LOIs before. So yeah, this stuff matters. Then next thing on key assets and partnerships is unique technology. So patents mean something. I've seen a lot of questions floating around our Discord server about patents, and yes, those matter. They can be expensive to pursue, so just be aware of that. If you're like, well, all I need is a patent, it's that easy. Just patents aren't free, and they aren't easy to get. But once you have one, that does make a difference in the valuation of your business and the investability of your business. Trade secrets mean something too, but they don't mean as much. They're easier to come by, obviously, but they don't mean as much. It's hard to quantify the value of a trade secret, especially since it's not legally enforceable, and it could be easy to steal. Strategic distribution. This is what Amazon built their business on. Now, obviously, Amazon was very post-revenue when they also built the best distribution network maybe in the history of the world. But Amazon, the true value of Amazon was in their distributor network, and so you can. So if you have vital distribution connections, again, better than nothing. That's better than nothing. You want to make a whole list of all of the stuff that you have if you don't have revenue yet, so that you can tell an investor, hey, really all the pieces are in place. I'm not counting on you to write me the $1 million check and just let me, go live a glamorous life and brag on LinkedIn about how I closed an investor. I'm actually getting ready to put your money to work. So the next category is exposure. Team and press signals, and then we're down to first steps after that. So the founder track record, by the way, so this one I grouped in with exposure just because it's, it fits well with other team and press signals. Founding history makes a difference, even if you failed. You guys may have heard me say this before. I heard this from a guy who's gotten 8 or 10 of his portcos into Y Combinator and got one of his own companies into Y Combinator too. He said the two things that Y Combinator looks for are an idea so crazy that it shouldn't be succeeding, but somehow is. Now that's a revenue thing. But also they want a team that has failed together previously. So even if you haven't exited, founder history matters, and especially if your founder team has history together. Now, what about team building? Oh, I'm a technical founder. I'm not really a team builder. How do I manage team building? We're going to talk about that on a later webinar. Now, the other thing about this is prior exits can move this way, way, way up the list. This is, in a way, this is not necessarily a traction signal. This is a team signal, which is almost like a separate category of its own. And if you have prior exits on your founder team, that is almost as valuable as revenue. And in some cases, it can be even more valuable than revenue. We can talk about team building another day. Press coverage. If you've got credible and verifiable press coverage, that obviously matters. Citing, in your ancillary slides, you can put in a thumbnail of a press story that was written about your startup, was written about even about your idea. Like, even if you're not to startup point, you're still at idea stage. You can get press coverage, and that stuff matters. Domain authority, recognized expertise. If you're an expert, an acknowledged SME, subject matter expert in the field, that strengthens your reputation and market position. But all content helps. Even if you don't have a PhD in the field, you can start doing stuff on LinkedIn. You can start doing stuff on Instagram. If your audience is young enough, you can start doing stuff on TikTok. Just get started. Be bad at it at first. I started doing more stuff on LinkedIn about a year ago, maybe 12, 13, 14 months ago. I wasn't very good at it. I was pretty bad, actually. And over a year, I've been able to build a pretty good presence on LinkedIn. You can do the same thing. Last thing is very first steps. So of these, the most valuable is completed MVP. We have a minimum viable product that's ready for testing. Now, for some of you, this falls much, much later in the process because you have huge CapEx that goes into building your MVP. But if you're running a service business, you can have an MVP and a shingle out tomorrow. And other businesses are varying degrees of in between. Social proof, garnered endorsements from industry experts and advisors. If you don't have somebody who's willing to join your actual founder team, talk to potential advisors. One thing about advisors, they are more likely to say yes if you are asking them for a low time commitment. And I know I've had negotiations with a lot of founders the last few months, and many founders expect their advisors to be very involved. If your advisor has a big name, they are not going to be very involved unless you have a strong personal relationship with them. And even then, I'm evaluating everything in terms of how much do I get and how much time do I have to spend on this. I, as an advisor, can generate a ton of value for a company just by putting my name and my exit on it. And so I'm not going to get into anything where the founder says you have to show up 10 hours a week. Absolutely not. I'm just not doing it. I don't care if you offer me 3/4 of the company. I'm not showing up 10 hours a week. I got too much other stuff going on. Think about your advisor's time commitment and how you can put their expertise to maximum leverage. The last one is customer discovery. Just market surveying. You've done the customer discovery. You've read the mom test by Rob Fitzpatrick, because you're not just going and asking people, hey, do you think this is a good idea? Would you buy this? People will lie to you. With the best of intentions to protect your feelings, they will lie to you and tell you it's a good idea, even if they would never buy it. And further, they don't know what their intentions are in the future, and they will say that they will buy it, even intend to buy it, and then when the time comes, actually not buy it, because people don't know what they're going to buy in the future. So read the mom test, find out about asking indirect questions, and do customer discovery surveying. That is the last. So these are the elements. So let's go through these one more time. So the list, obviously, revenue is the best. MRR, number one. Non-recurring revenue, number two. Deposits and deals, number three. User engagement, engaged users, retained users, and a qualified wait list. That's your list here. Doing business but not getting paid, key assets and partnerships. LOIs and maybe MOUs. Unique technology, patents. Trade secrets, maybe. And then a distribution network. Exposure, founder track record, press coverage, and domain authority. And finally, your first steps, if you're just getting off the ground, a completed MVP obviously is the best of these, social proof endorsements from industry experts and advisors, and then customer discovery. So with that, that's the end of our traction presentation from a formal perspective. Now let's open it up for Q&A. Anybody feel free to raise your hand or to drop a message in the chat if you're unable to speak for whatever reason. I will stop the screen share. What you got? Erdem, go ahead.
Hey Ben, thanks for this insightful webinar. I just wanted to challenge your first slide, not challenge it, but to provide some key insight. You mentioned that very rarely there are startups that are rightful to complain about. We cannot invest, we cannot create revenue, and our case is fitting in that minority. Let me open it up.
Okay, go.
Remedy is the first buy now pay later offer in medical tourism. It's a consumer credit company. So when you are underwriting credit, you need investment. It's literally a bank infrastructure.
Okay.
Compliant, regulated, this and that. So for us to create revenue, we completed the product, let alone the MVP, the prototype. Forget about them. We have a proper tier one bank grade infrastructure, but we are still pre-revenue. So I just wanted to provide a key insight. The credit industry works differently, and this is where we sit. I just wanted to share that.
Yeah. So if you're seeking debt, I see your hand, Seekly. I'll get to your question in just a second. So debt capital. Debt capital, yeah. Even without that proviso about having to have investment first in order to get credit, I would not expect that anyone would be able to. I mean, other than a founder with a previous giant exit, that they would be able to. Yeah. Would be able to go get debt in any situation for a startup, unless it was if it was like a real estate startup with like highly collateralized assets or collateralizable assets, maybe, or something that was like some sort of brick and mortar startup, like like a WeWork type of thing where there's like a heavy land element or physical asset element of it. Debt is really hard to come by pre-revenue, and I think in any situation. So you're right about that.
Very briefly, I would support that with example. There are 10-ish unicorns in buy now pay later or consumer credit industry today, and 9 out of 10 raised 2 million before revenue, and on average, in 12 months, they launched their MVP, and the following 6 months, some of them went to IPO. So they never touched the VC ground.
That's a
Most of
nice world to live in. I wish that was my story.
it's a
Uh,
totally odd industry we're in. So I just
yeah.
wanted to share that
Yeah,
with
no,
the.
thank you for sharing that. Yes, that tracks. I have no disagreement with that. Thank you for sharing that. Sigli,
Thank you.
what was your question?
Hello, Ryan here. Right.
Oh, hey, right.
How you doing? I just wanted to follow up a little bit there. I kind of understood it differently
Okay,
from what you were saying.
sure.
And this is to Adam. I think the majority of the companies fall into that category that you were explaining, and they do wrongfully say those things. And Adam, I come from your kind of that kind of company because I had a deep tech company, and I think we are kind of the minority,
Okay,
and something like kind of like exclusive cases where we do need investment. If you are into deep tech or some kind of fintech or stuff like that, it's really hard to create customer base or paying customers without investment because it takes a lot of research and a lot of investment. R&D has to be there before even getting the approval from a lot of other industries. So this is the way I understood what Ben was saying when he said a lot of companies wrongfully say this stuff. I think we are the kind of the minority and the exceptions to this rule. Just
you,
wanted
you
to point that out.
certainly, yes. And let me back off that position a little bit to say that there are certain situations where there does have to be a meaningful capital expenditure before it's possible to make any revenue at all. That does happen. I think that there are a lot of founders. I guess the reason that I brought that up is I think that there are a lot of founders who think they're in that situation who actually aren't. It often happens among young founders, and I'll listen to their story and say at the end, there's one in particular I'm thinking of that I met with in the last week or so. I remember thinking, my friend, you don't need investment, you need customers. And if you don't have any customer interest in what you're doing, your product may not be as valuable as you think it is. And the reason that this is so important is the only thing worse than not taking on investment dollars and then realizing your product actually is not something that people value is taking on somebody else's money, going and spending $1 million of somebody else's money, and then realizing that your product is something that people don't value. So if there is any way to not have to take on investment, you want to go any other road other than taking on $1 million of somebody else's money. But as you said, Ray, and as Erdem said as well, there are certain situations where it just can't be avoided. My point is just that many founders think that they're in that situation, but they actually aren't. They need to go get customers. And the reason that they are not making revenue is not because they haven't gotten investment. It's because their idea is actually, the baby is actually ugly. And that's not a shot at them. You know, it doesn't have to be this idea. People feel like it's so personal. And I understand why we fall in love with, like this project. You have to love what you have to love it to some degree. And you have to, you have to buy into it 100%. But it can be hard to admit, hey, this actually isn't going to work. People don't value this. They're not going to spend money for it. Everybody said they loved it, but they don't. That's a tough place to be as a founder. But sometimes it's something we have to acknowledge. And not getting investment yet, being this close, but not getting an investor is often something founders will hide behind in that situation. All right, who's next? What other questions do you guys have? Ask me anything. Well, maybe not anything. I'm not going to talk details of my recent exit, and I won't tell you my kids' names. Yeah, go ahead, Erdem.
No, I have a question. So,
Yeah.
MRR revenue is everything. We've learned it the hard way.
Yeah.
But from an investor point of view,
Yeah.
A naked number won't cut it for you, I guess. What are the key elements you're looking? Are you looking for hockey stick at the early stage? What makes it work for you to click or to sign the term sheet? What for most of these KPIs I can ask it, but for specifically for MRR.
Yeah, that's a great question. And I mean, a hockey stick does really help. Often, another thing that, one thing that I invested in a couple of months ago was this AI company called Pure Code. And what they had was and you guys can go look them up. But they had immediate MRR. I think they had, within 8 weeks of when they put their product on the market, they had $250,000 of ARR, not MRR, but $250,000 of ARR within 8 weeks. And I looked at their valuation, and I did some very simple math in my head. I didn't write anything down, and I thought, this makes sense. In 8 weeks, if they could build this kind of traction at this valuation, I'm absolutely in on that. And so something that immediately, it's sort of the opposite of what we were talking about earlier, where it just hits the market and immediately people are paying for it. So there's no hockey stick there, but it just like they jumped in at a very high level. Now, it's an unusual thing in the market. I wish the market was fair. The market is not fair. Like those guys just happened, across something that happened to be really valuable to people, and credit to them. They busted their butts putting it together. But other elements of MRR, and I see your hand, Adam. But other elements of MRR that are important, there is a degree to which stickiness matters even with MRR, like sort of what's your attrition been, how much has the client base fluctuated, that kind of thing. How much of the MRR is concentrated into a few clients. And if it is highly concentrated, how strong are the relationships? Now that stuff is difficult to quantify, and founders will embellish the strength of those relationships. So as an investor, you just kind of have to go on. You kind of have to go on feel at that point, and listen to what the founder says about other things to determine how trustworthy they are. That is a big deal. Like, founder trustworthiness is something that is very, very hard to quantify, and we make bad judgments about it all the time. A lot of investments think, I built a successful business, I'm a great judge of character. I assume that I'm going to be wrong about everything. So if I can't attach numbers to it, I just assume that I'm making a stupid mistake. But I have to make some kind of decision. So concentration of MRR, stickiness of MRR, and growth, like you said. So those are I think three of the things that I would look at. Other investors might have different answers.
Cheers.
Adam, what you got?
Actually, this is from Prama in the chat. Says that what if your startup has no traction or revenue, but a similar product were in the market generating a good revenue? Is that validation for your products MVP's market demand?
Yes, it is. And so here is one of the biggest disconnects that we see between founders and investors. Founders love to say no one else is doing this, and investors hate to hear the words no one else is doing this. When a founder says that, they say we are the first. When an investor hears that, they say you are the last, or you are the only. Like, nobody else sees value in this because the market doesn't see value in it. Now, there are certain situations where the first to market wins, but I'll tell you one industry where that didn't happen: ride sharing. How many of you guys everybody thinks Uber was first? Nuh-uh. How many of you guys have ever heard of Sidecar? I have, only because I thought about going to work with them when I was broke in 2011. Now, Sidecar was first to market in ride sharing, and they went bankrupt. I think Uber was second and Lyft was third. But people love to see that there's somebody already in the space. Almost every market will support a second player. Many markets will support a third, fourth, fifth, sixth, seventh player. But if you can just show investors a single comp, we're trying to do this, and we're differentiating from those guys in this way. Just give them something they can anchor their investment expectations to, and then they'll ask you questions about, all right, what do you know about their EBITDA? What do you know about their customer acquisition cost? What do you know about their lifetime value? Like all of that sort of thing. And then they've got something that they can look at and say, okay, there's an example out there, even if it's just one. So yes, like founders think, oh, I want a space where nobody is playing. Investors actually want the opposite. They want, if your startup has no traction or revenue, a comp is 60, 70, 80% as good as you actually having traction and revenue. So weird answer, and doesn't make sense to a lot of founders, because we all want to be, Jeff Bezos or Elon Musk, or or start, whatever you might think of those guys personally. But we all want to start something new that nobody else is doing, and investors hate that. So great question. No, thanks for the question. Yeah. All right, who's next? What else we got? All right, Erdem, what if the startup is the first mover, but a giant like MasterCard enters the game? So, obviously that can go a couple of different ways. One is you end up being a giant slayer, and that's a wonderful story. That's glorious. It's an unlikely outcome. What is more likely is the outcome you want to aim for is to get acquired by them. It's not a requirement, but then you want to start thinking about, all right, what is the stuff that they don't have yet? What is our edge over them? We realized that we were dealing with a larger market player in the podcast and content marketing business in 2021, or maybe early 2022. And it was another company north of us in Texas, and that they had broken off from Multiview. And so we realized that there was a much larger player. They weren't the ones who ended up acquiring us, but I started spending a fair bit of time thinking about, all right, how are we different from those guys? If we wanted to talk to them about an acquisition, what would we advertise? What would we hang our hats on? It ended up being that there was another player in the managed growth services space, not an MSP, but an MGSP, that had a much stronger need for what we were doing. But yes, so that if a large player, large name brand player enters the market, you do have to pay attention to that. Now, you may be able to just outright compete with them, but just bear in mind, they've got more money than you. They can outspend you on everything, including talent. So you want to start thinking about, all right, how can we make an attractive acquisition for them? You may be able to beat them, but it's often more profitable to join them.
Mm-hmm. Thanks.
Right. Absolutely. Great question. Karan.
Hey, everybody.
Did I pronounce your name correctly? Is it Karan?
It's not, but it's okay. I don't hold that against you, because nobody non-Indian can pronounce this name. The problem with the name is it's
Karan. What's the correct pronunciation? Karan?
Yeah.
Karan.
Because my name doesn't have vowels in Hindi.
Okay.
So the two A's you just add for the phonetics in English. But anyway.
I see. Karan.
Yeah. Thanks for asking either way.
Yeah.
So I want to share with you two things, and then let's see how you sort of what do you think about that?
Sure.
And how that fits in the conversation. I have a VC friend of mine who used to be a founder, then exited, made good amount of money, became a VC, hated it, left VC business. But when he was VC, he advised me, because at one point I was considering VC funding for my company, and he told me three things. One thing was, you're going to make around the same amount of money as if you exited at Series A, as if you exited in IPO or big exit. You got to make about the same amount of money because of the dilution, because of the liquidity preferences and stuff. The other thing he shared with me is that VCs want winners or losers. They don't want averages.
That's right.
Yeah.
The second one is true for sure.
Yeah. Basically, they want to see you as a company that's taking a huge risk, and you're going to either make it really big, so they're going to make their whole fund from you, right?
Mm-hmm.
And that's the third thing he told me is look at the fund size. If you want investment, look at their fund. If they have 50 billion asset under management, that's what they're planning to make with their star. If they're 50 million, that's maybe more, where they're willing to give you $1 million for something. Yeah. So look at how much asset under management they have.
Yeah.
To anchor the conversation. So that's point number one. The other point is, I think market matters a lot. If you're in the right market these days, if you're in a market where you're using some sort of AI to do something fancy, you're getting money thrown at your face, right?
Yes.
From left and right. Whereas there are a lot of products and services that are doing really good business, but investors are not seeing value in them. And I think that fits in with the point two that I made, which is they want either winners or losers.
Right.
They don't want healthy companies. They don't want averages.
Yeah, I would say that's broadly correct. So the phenomenon of winners and losers, as you say, you have one home run that anchors your portfolio, and I think as a family office guy and an angel myself, I guess I'm technically I'm sort of a VC, but not really. But I hang out with a lot of VCs, and I do think that they're like everybody. I think that the smart VCs are not necessarily doing exclusively unicorn hunting, but everybody does want the 10x, 100x return, and I mean 10x is that's a 1,000%. Like if you get that over a 5-year period or a 7-year period, I mean that's an IRR of 3 doubles. So doubling every 2 or 3, I mean, it's a 40, 45, 50% IRR. So that's, for a 10x, and then obviously for 100x, it's, many times that. So yeah, I do think they want you to scale or fail. And that's why you won't see a lot of VC interest in, there are people that show up on the angel investors subreddit sometime asking about brick and mortar shops and things like that. And those can be good investments, but they're not particularly good venture investments. They're not venture backable. They're not even really good angel investments. And that's kind of unfortunate because it means that a lot of those people, if you're getting into a traditional business, you either have to build it slowly yourself as the operator over time, or you have to find a friends and family investment. So I've invested in a couple of businesses like that, but even myself, like I'm mostly looking for stuff that's scalable. My most of my investments this year have been fintech and AI. There's a couple of other things that I've gotten into, but yeah, I would love to say no, I'm different. I'm much more courageous than all the other investors, but the truth is I'm not. Like the things that I think I emphasize probably over some investors. Not that this conversation is about me, but I like buying. I like investing into just pure unfulfilled orders. The orders are made, and that kind of goes back to the traction earlier. Like the letter of deposit the deposit's already made, the order is signed, they just need order fulfillment. And then the other thing is rapid revenue growth right off the cuff, like I was talking about with Erdem. But Karan, the winners and losers phenomenon is definitely there. Now, your first point, you were saying something earlier about kind of looking at the fund size, and that definitely determines what size of a check they're going to write. If they have 50 billion AUM, like they're not going to get involved in any company that needs a $250,000 investment. Why would they? So you do need to find out how big their venture fund is, or the fund that they would allocate, and where your allocation would fall, and that's going to determine their check size. They're usually going to be allotting that to between, I would say, between 15 and 40 companies. Lower than 15 and you're just not diversified enough, at least in my opinion, and more than 40 and you got too many to babysit. And I would say it's generally going to fall between 20 and 30. but 15 wouldn't surprise me. 40 wouldn't surprise me, but a number outside that range would surprise me a little bit. So, and then there was another, I don't feel like I answered your full comment though yet. There was something else that you said that I feel like I didn't get to.
I think the first point, by the way, spot on pronunciation right there, which you just, when you said, Karan.
Oh, thank you.
The first point was that you make about the same money in Series A as a founder as exit due to the dilution and the liquidity preferences.
Yeah, I'm not sure. So he's dealt with more of that than I have. Most of my investments have been, have been seed round. I've done some pre-seed, done a little bit of Series A. I've had some stuff that's done well, but no major exits on the investment side yet. So I haven't seen anything go all the way to IPO yet, and have not seen, like massive unicorn exit or anything like that on the investor side. And our company was not a unicorn either. So that one feels like it's a little bit more case by case to me.
Yeah.
Like just from the stories that I've heard, I feel like what he might mean, maybe he just means, hey, it's all the same. What I think is probably more likely is after Series A, you hit pretty significant diminishing returns.
Yeah.
And
he didn't say exactly the same amount, similar. It's like maybe in Series A, you walk away with 25 million or maybe 50 million, whatever, if you sell the company to a private equity firm. Right. And then you're raising and raising and raising, and your company is worth now billions. You're not going to see $1 billion in your pocket. You're probably going to see, double your Series A with all the hassle, all of the, late nights of working and so forth, and going through the hamster wheel. So I think maybe that's what he meant.
Yeah, I think that's definitely true. Like the more venture you take on, and I know some VCs who are great people, like really, really, really good people. But just the more people you're answering to, the better odds that somebody's going to be upset with you. Somebody's going to be mad at you because you're not at the office at 11 p.m. And you might be like, your reaction as a founder might be, well, that's not anybody's business whether I'm at the office at 11 p.m. I mean, get ready for the phone call, because you're going to get it eventually. So because that's their money, and they have LPs that they're answering to. If anybody doesn't know what that is, that's a limited partner. So somebody who invested in their fund before they invested in you. They have bosses too. They are, in some ways, they are your boss, and the LPs are their boss, or they're at least somebody that they have to answer to. So before you get mad at the VC for crawling into your hip pocket, just understand they have people crawling into their hip pocket as well. They're not just sitting on a beach in Aruba and calling you up because they're annoyed with you. Like they have an audience as well. So anyway, anything else on that, Karan?
No, all good. Thank you very much.
Yeah, thank you for your questions and comments. Those are very helpful. All right, anything else, guys? We got a few more minutes if we have another question or two. Yeah, Adam, what's up?
One in the chat. I haven't read through this. So Shannon says MVP almost ready to launch, but bootstrap funding is very limited.
Okay.
Early usability testing of functional prototype received positive feedback. At this point, would you recommend angel pre-seed funding for the public launch to get more rapid customers, or do it more slowly with credit cards, business loans to get initial data, then go out for funding for fuel growth?
Thank you. Yeah, thank you for that question, Shannon. That's a great question. And I would say, from the way the question is currently worded, I would try to get more. I would share this in our Discord server and share more of the details to get a little bit more granular with exactly what what you have access to in terms of what sorts of business loans do you have access to? What are the interest rates on those loans? What are the interest rates on the credit cards? What would get you over the hump from an angel pre-seed funding perspective? Like, do you need $1 million? Do you need 100,000? Do you need $1 million? Do you need 30 million? And 30 million is going to be hard to raise, but just what is the number that helps you get there? It said MVP app is almost ready to launch. Like almost is a tricky word. So I would share more of the details, and if you tag me on the Discord, on the Founders Group Discord server, I'll tag in some people who I think can help answer your questions. Thank you. And you're welcome to tag me on that post. Erdem, I see your next question. real life pre-revenue traction examples that made you write a check? Yes. Yes. So I committed to two pre-revenue platforms in the last 8 months, and particularly at the intersection of AI and fintech. Both of the fintech companies I've invested in in the last 3 months have been post-rev, but I guess what got me involved in the two pre-rev recently, and the ones that have fallen within the last year, was I had a good relationship with the founder, and I felt like my advisory perspective was going to be very helpful. So I got, and this is from a selfish perspective, I got a lot of additional juice from the advisory value, and so there was a way for just telling the full truth. There was a way for me to benefit significantly from non-capital contributions to the project, and that made the juice worth the squeeze. And also, on top of that, I was extremely impressed with the founders, and just they both impressed me with their persistence. They both seemed smart. They both seemed like people who would make it happen. They were kind of after me, not just for the capital, but for like, this is what we need to, to make the next steps forward. How can we get there? Like, and they would give me very straightforward, simple questions to answer, and not say, we don't know what to do, tell us what to do. If that makes sense. Like, if you have an advisor, taking them through a very straightforward process where they can answer just one simple thing that their subject matter expertise relates to, that can be extremely valuable to an advisor, because we're back to that sort of time leverage piece of it. So yeah, I would say those two situations were actually very similar. So again, I would love to say, oh, there are all of these situations where I would do that, but the two in the last year have both looked exactly the same. So maybe I'm not as diverse a thinker as I would like to believe I am. But those are the two most recent examples. There was another pre-rev that I invested in a couple of years ago that springs to mind, and I've done a couple of other pre-rev investments, but the other one that springs to mind, no, that one wasn't truly pre-revenue. It was very early revenue, but it was a founder I knew, had a good relationship with, previous exit. And actually two previous exits, one small one, and then one that was pretty good sized. And there I just really believed in the product. And I was like, and my reaction to the product was, I can't believe, I'm contradicting myself here. I was like, I can't believe nobody else is doing this. This feels like a very obvious win. So don't listen to me, founders. Don't listen to me. I said, I can't believe it. Nobody else is doing this. So I contradicted my own investor rule. And now to be fair, that one didn't work out. That the company has already gone broke. But I would invest in that founder again. So that's one of the best endorsements that an investor can offer you is, she lost my money, he lost my money, and I would still invest in them again. Information. Investors love feeling informed. That's a huge piece of it. Is will they come back and back you again if you lose their money? All right, let me see what else we got. I see some note taker stuff. Seekley commented. Ray, what you got? And Victoria, I see your question as well. Go ahead, Ray.
I just saw all these note takers that are really hating right now, and I just commented to channel like just launch the MVP, please, just as soon as possible. Put that product in front of real users and get that valuable feedback. It doesn't need to be perfect. It has to be shitty. It doesn't even need to work completely. Just put it out there. Put it out there and iterate, please.
Yeah. Okay, next question. Victoria Farias, thank you for your question. What are the key things a creative or consumer IP brand should highlight for investors who usually back AI or fintech? Okay, good question. Is it about traction, TAM, margins? TAM is total addressable market for any founder who doesn't know. Margins, or showing IP as its own scalable engine? Is it something you see VCs investing in? So it really depends on the brand a little bit here. Like a creative IP to me, I hear the word creative. I was a television writer for 8 years. So, I love my creatives as a person, and as an investor, I run far, far away from anything that says creative. Just being honest. I do not get involved. And now, so what you need to think about is how you frame it from a commercial perspective. So if the chief pitch is it's this really super strong creative brand, I'm just out. But now consumer IP brand, that's something different. Like that's just B2C. Like so I would need to know more about so to answer the other questions that you had, is it about traction? Yeah, that's helpful. TAM, yes, those are items 1 and 3, traction, team, market. So yes, those things are both helpful. Margins, yes, if you're post revenue, like projected margins, yeah, I mean, we can say whatever we want, but I don't know how helpful that really is if people aren't actually buying your product, because you might think your gross margin is going to be unbelievable, and then you get into the game and it's actually nothing like you thought it was going to be. Showing IP, the other thing you mentioned is showing IP as its own scalable engine. I don't know exactly what that means, and forgive my ignorance for showing the IP as its own scalable engine. I guess that could mean something like the IP propagates itself in some way. I don't know exactly what you mean there, but if you want to provide additional context in the chat, you're welcome to, and I'll do my best to answer the question. Consumer IP can be extremely valuable. That is, B2C is not something I'm particularly an expert in building, but it's certainly something that I would consider investing in. So yeah, I think consumer IP can be excellent. But yeah, traction, TAM, margins on executed business, yes. And is it something you see VCs investing in? I think most VCs will have an approach that's approximately in the neighborhood of mine. I think most of them are not going to back creative brands unless they know for sure that they're commercial. It's going to be it's really going to be about commercial value, because that's what gets them return. But consumer brands, yeah, absolutely, they may back a consumer IP. It just really depends on, do you have more than just an IP? Like intellectual property on its own, without a solid business built around it, doesn't have any value. Ricardo, thank you. Thank you so much for joining us. We appreciate you being here with us today. Any other last questions? We got time for maybe one more. Thanks, Victoria. Appreciate your question. Anything else? Okay. All right. Well, everyone, thank you for joining us. If you're not in the Founders Group Discord, please feel free to jump in. We'd love to have you. I can get you the link. You can email Adam, who I think. And Adam has posted. Adam, go ahead and make an announcement about this. I see your chat, but yeah, go ahead and announce.
Yeah, sure thing. I know there's a lot of people that have joined the server and probably missed this, but we as a group are going to do some testimonials. So I posted a link in there in terms of
in there is in the chat, in the Google chat.
Yep, exactly.
Google Meet chat.
Yep, exactly. So if you look there, and then there's also another one I'm putting together. It's a YouTube series on how to start up a startup. I'm going to be posting that one. It looks like my thing was too long. So there's the other portion of that. So that's the first one. The testimonial is really only going to take about 5 minutes. So I put in 15 minutes just in case we wanted to banter back and forth and just learn about each other. The other one is probably going to take about 20 minutes. So that's how to start up a startup. So just something that we're doing for marketing purposes. And it's a great way to get yourself out there, and so the world actually knows about you. So if you guys are interested, go ahead and book something with me. I got plenty of availability, about 12 hours a day. So that's all I got.
All right. Thank you, Adam. And thanks for all of your contributions to the community. Guys, Adam does incredible work with us for the Founders Group, and he's a good friend as well. So if you haven't gotten to know him yet, please do.
Thanks, brother. You do a lot as well, so we appreciate you more than you ever know.
Well, and it's all in the name of helping founders. Like there's a lot of people said yes to me when they didn't have to, and so it's incumbent on me and on us to those of us who have been fortunate to have start something that works and have an exit and so forth to give back to those who are still working toward that, and to work with those who have had it and are looking for the next one. We all help each other, and the community builds on itself. And this is what creates more jobs for people. The more people who are doing founder stuff, the more jobs for everybody else. So that is what helps all of society in the long run. We are the value makers, and there is something to be said for that. So thank you, all of you.
True.
Thank you, all of you, for doing the stuff that you're doing.
Pay it forward.
Yep. Okay. All right. I'm going to go ahead and cut it off. Thank you, everybody, for the time.